Hello, everybody, and welcome to the latest edition of the LPL Market Signals podcast. Jeff Bookbinder here today with my good friend and colleague, Barry Gilbert, filling in for Ryan Dietrich. How you doing today, Barry?
I am doing okay. Long weekend for us, so enjoyed some R&R. I'm ready to go.
Well, me too. I'm energized by that half-court shot that Gonzaga hit. Jalen Suggs, I think is his name, hit to win that game. What an amazing Final Four game. Certainly enjoyed that one. When you play hoops, Barry, do you often sink half-court shots to win games? Is this something you're familiar with?
Yeah, just to make it fair, I make it a hook shot. You know, it's otherwise I just hit them all the time.
Yeah, I like a bit of a challenge too, so that makes sense. So let's get right to it. The agenda for today, we're going to do a really quick, well, there you see the important disclosures. First of all, the agenda is this. We're going to do a really quick recap of Inflation Week. In the LPL Research department last week, we did a number of blogs and commentaries on inflation. We also talked about that on the podcast last week, certainly a hot topic. Talk a little bit about what happened in the markets last week. Then we're gonna show you a couple of pictures of where Ryan is and why he's not with us, which will tie into the reopening story, because that's really the focus of our weekly market commentary this week. The economy is reopening, economic activity is picking up, and therefore we have raised our forecasts. So we'll spend a little bit of time on that as well. And then we'll end with the jobs report from Friday, a quick recap of that, and then a look ahead at what's going on this week. So let's get right into it. The first slide here, you see Inflation Week and that scary shark. I think the number one point we tried to make here in Inflation Week is that we think this upcoming bump up in inflation is going to be temporary, right? One of our blogs last week was 10 reasons why we don't expect runaway inflation, why we don't expect high inflation to be sustained, but we are going to see more inflation here, Barry, over the coming months. How should investors think about that?
Yeah, it's we are going to get more inflation. It's near term. I love that blog piece because if you think further out and all the forces that have kept inflation in check, it looks like most of them are still going to be in play. Including once we get past this growth spurt, growth getting back to where it was in the last cycle. You know, we might be talking about 2%, a little bit lower, a little bit higher. That should help to keep inflation in check over the longer run. But near term, certainly going to see it. We're rolling off some tougher numbers. We have some relatively easier numbers in there. So we're going to see a jump just from the year look back, what things look like. That's a little bit artificial because that has more to do with what was happening last year than what's happening this year. But we're not, we'll watch it carefully. We're not that concerned if we see a temporary lift. The big question for us is what's going to happen in the longer run.
Yeah, absolutely. It's like, when you got a bucket of water, you pour it all out, it takes some time to fill it back up. And so we're still in the process, I think, of filling that water back up in the bucket, and then eventually maybe it overflows. We'll see what happens, but we're a bit a ways from that part of the inflation cycle. And inflation is important for stocks, as you see in the next slide here. This is from one of our blogs. Again, you can find our inflation blogs on lplresearch.com. Stocks tend to like low inflation, right? That probably shouldn't be a surprise to many of our listeners. You see here, for those watching on YouTube, if you get inflation under 2%, returns are really strong. In fact, if inflation is negative, you get 25% returns on average. If it's 0 to 2, you get about 11% returns on average. So I thought this was a a really good way to illustrate how inflation is important. You also see on the other end of the spectrum, if you get really high inflation, that's when you get depressed returns. Still on average positive, but stocks are up an average of about 3% when you get inflation north of 6% historically. So let's also let's turn to a recap of last week's market action. It was the jobs report was the big news of the week on Friday when the market was closed. At least the equity market was closed. But stocks were higher for the shortened week. S&P up 1.1%, Nasdaq up 2.6%. So it was a growth-led rally. That's why the Nasdaq did so much better. I think, Barry, the most important takeaway for me, we'll get to the jobs report in a bit, but the important takeaway for me is that we saw growth stocks do better as yields stabilized, right? We're talking about tech, talking about the internet names that are in the communication services sector, consumer discretionary, where Amazon is. What are your thoughts? Anything stood out to you last week?
Yeah, I think that was it. What an interesting day. Right? We had this great jobs report, which we'll talk about in just a minute, which basically says reopening is on. It's happening, and we're looking around this morning. Didn't have a big move in yields. Didn't see the value style stocks jump out and outperform, which means that the reopening might be getting reassessed just a little bit. It's just one day, but it was an important report, and it was a big beat on the headline number.
Yeah, absolutely. So, in fact, why don't we go to that slide next? The jobs report, since you're on the topic. We still got a ways to go to, just like with inflation, we're filling up that bucket of water. We haven't quite gotten back all the lost jobs, but we've made a ton of progress, having lost over 20 million jobs. Now we're only down about 8.5 million jobs. And after Friday's jobs report up, it was a couple 100,000 jobs ahead of consensus, a little bit more than that. That's probably the last sub-million jobs report we're going to get for a while. 916 was the actual number. We could see, 2 million jobs created potentially next month, or in the current month, or maybe even in May, as this reopening continues. So the outlook for the job market is getting much better. In fact, we could end up getting back all these lost jobs by the end of the year, which would really be remarkable, Barry.
Yeah, it would be something. And I would not be surprised over the next few months to see at least one jobs report with 2 million jobs gained. We know that a lot of those jobs were lost in the services sector, services-oriented industries in particular that depend on foot traffic or traveling. We're opening up. Those jobs are going to come back. Those are the hardest hit areas. I think we're going to see some nice numbers.
Yeah, we saw about 260,000 new leisure and hospitality jobs. Certainly that is, an area where you would expect to see big numbers in the coming months. So we'll certainly be watching that closely. I guess the last thing I'll mention on last week was the ISM report. It's one of my favorite reports. They survey manufacturer or purchasing managers in manufacturing companies and ask them if they're going to spend more. And that number was just shy of 65, which is a huge number. Manufacturers have done better than services businesses during the pandemic. And so the fact that number is stronger than what we've seen from services, the services surveys, isn't that surprising. But a number like that is historic. So this is just another example of how this economy is really roaring back. So before we get to our raised forecasts, Barry, I think we want to check in on Ryan Dietrich, who's not with us today. My question is, where's where's Ryan? You have any idea?
I think we know that Ryan follows the stock market, as we all do, very closely. And last close we had an all-time high. I think Ryan said to himself, "Look at that market. I think I'm going to go to Disneyland."
Well, Disney World to be specific.
Disney World,
yes.
That's right.
So here we have a picture of Ryan. We actually have two. Here's where Ryan is. If you go, I'm sure I put it in there. There it is. There is Ryan. Ryan is having fun at Disney. We put the mouse ears on him with his family down there. I know he's having a great time. I saw on Twitter a couple of pictures. We didn't have time to get those in here, but that's where he is. The next, we have another picture of Ryan too. You can see, for those on YouTube, Ryan on a roller coaster. This the facial expression, I think, suggests that he's pretty scared. Not one of those people that just, smiles and puts their hands up. He's holding on for dear life there, no doubt. So be safe, but have a blast, Ryan. We miss you. We'll see you back here next week. So now we'll get to the feature of the day, which is our increase in forecasts. So first, the GDP forecast. So, we just talked about the reopening. We all know the vaccine rollout is ramping up. Actually, north of 3 million shots per day in the U.S. now, which is, it wasn't too long ago we were talking about 1 million shots a day as being pretty impressive. So this thing's really gaining momentum. And, it's a race against COVID cases, and it looks like the vaccines are winning, and we expect that to continue to be the case, even though we have had a little bit of a pickup in COVID cases over the last few weeks as economies have reopened and the variants have spread. But nonetheless, this reopening is going, and people just have a really strong desire to get out. Ryan, there's no better example of embracing the reopening than going to Disney. I saw box office stats. It was something like $32 million on this King Kong versus Godzilla movie over the weekend. You've seen it in the mobility data with people going to restaurants, making reservations on Open Table. Stats on driving, on commuting, all of that. It's really, it's all just pointing higher. And so that tells us that, when combined with all the stimulus that we've talked about here week after week after week, that this economy is going to grow north of 6% this year and potentially make a run at 7%.
Yeah, it's, we had the stimulus story. We actually upgraded our forecast then. Vaccination story just has been strong, been doing very well in the United States. We're in a little bit of a race with some of the variants on COVID that spread more easily, but it looks like right now we're probably going to win that race. We know there's some risks because we saw what's going on in Europe, a little bit further behind on the vaccinations, got hit earlier with the variants. They're needing to partially shut down. This is not going to be like the prior shutdowns. It's going to be temporary because they are vaccinating as well. But it's a great story over the last year that we've had.
Yeah, absolutely. So we're taking our GDP forecast for the U.S. up about 1.25 points, leaving our developed international forecasts alone because of Europe's struggles, although there could be a little upside in Japan. And then the U.S. better growth forecast in the U.S. flows through. So we're taking up our EM and global forecasts a little bit too. Global now potentially north of 6% as well. But, the U.S. could lead, at least based on these buckets. And 7% growth, that is historic. We haven't seen that in 4 decades. It's, this is why you have people concerned about inflation, but no doubt that better growth is going to drive more revenue opportunities for corporate America and stronger earnings growth. So that's why You see on this next table why we're taking our earnings growth forecast higher as well, going from $170 per share to 175 plus. That is north of 25% earnings growth in 2021 for the S&P 500 index. Really, really strong. In fact, that our GDP forecast could prove a little bit conservative, even raised. I think it's the same story here, Barry, where frankly, I wouldn't be surprised if we hit 180, depending on how the reopening progresses, because corporate America has been doing so well, generating efficiencies during the pandemic, managing the disruption so well. And then as the economy booms and the stimulus kicks in a bit more, that's a tailwind for corporate America.
Yeah, we've seen the great resilience. You've talked about acceleration in the adoption of technology. You can see that on this call right here. And we're hoping that maybe corporate America will get the best of both worlds. They'll have all that extra technological adoption and innovation, but also start to get back the benefits of more people working in person. That resilience can just continue and potentially extend from here.
Absolutely. So with the our improved outlook for economic growth and earnings, it certainly makes sense that you get some upward pressure on yields. So we're taking our yield forecast up to for the 10-year, going from 1.5% at the midpoint to 175 to 2%. So narrowing the range and raising the level. It's really a simple story. It's mostly just about better economic growth, plus the 10-year yield has moved to around 170 at last check. So it's getting close to that range anyway. But we also, our fixed income strategist, Lawrence Gillum, has a model that he uses to assess fair value of treasury yields. And that says this is about where we're going to be, right, Barry?
It does, and Lauren's going to write about that a little bit in our blog that you mentioned tomorrow. There are two pieces to this. One is we expect rates are going to continue to push higher. The other side is that the pace of the increases is expected to slow down quite a bit. As rates move up, bonds become more attractive for buyers. We think for international buyers right now in particular. And that means that we've moved at a pretty incredible rate. We might jump outside of that zone for a little bit, but by the time we get to the end of the year, we think we're going to be back in that 175 to 2% range there.
And continuing this theme of potentially being a little bit conservative here, we have not raised our S&P 500 target. We've kept it at 4050 to 4100 on the S&P 500 index. We're pretty close to that low end of that range right now. So sure, you could interpret that as conservative, but we may end up raising that forecast fairly soon. But we had some, I think, sound reasons for why we did that. And one of them is as interest rates rise, you tend to see price to earnings multiples contract. At this stage of the cycle, and we've seen this in technology recently, right, where some of the higher PE stocks have suffered as rates have risen because of the impact on valuations. So as interest rates rise, we think gradually, but as they rise further toward 2% this year, we think that will potentially lead to narrower valuations for stocks. That was probably the biggest reason why we kept that there, but there's certainly other reasons. Barry, what would you add to that for why we would keep that forecast unchanged despite higher economic growth forecasts and higher earnings forecasts?
This is typical of what we see early cycle, even a healthy early cycle. We see earnings go up, often exceed expectations, but at the same time, we see those valuations potentially stay steady or even come down a little bit, and those provide a little bit of an offset for one another. So this is the normal pattern for the overall health of American corporations. We're really focused on those earnings, and then the other question is, what are investors willing to pay for those earnings? And from that perspective, the news is positive, but we're not adjusting our fair value at this point.
Yeah, that is a fair value forecast, a fair value range. So sure, stocks could trade above that, but that's what we see as, at this point, the value for the S&P 500 at the end of this year. I guess the other reason I would throw out there, when you raise your S&P 500 target, you're signaling to people to add equities, and we didn't want to send that signal right now. We might later, but we're already overweight equities. In fact, as you probably saw last week, we reminded folks it was the 1-year anniversary of our decision to upgrade our equities view to go overweight equities, which we did, I believe, on March 30th of 2020. I went back and actually read the commentary that we wrote back then. It's held up pretty well. It was actually a joy to read that, not just because it's fairly accurate, but just it's important to remember where you've been, right? And just how terribly tragic it was back then. It's still tragic. People were still losing lives, and how devastating the economic impact was. But we have come so incredibly far since then. It's just it was a pleasure to focus on the progress coming from that dark place. So it's been quite a ride, but we just decided that after 75% rally in the S&P 500, maybe you need a little bit of a digestion period as well. So we're being a little bit more cautious with the that 4050 to 4100 target, not signaling to go even further overweight equities relative to your target. Just sort of maintain a modest overweight to equities, which is what we've been doing in the portfolios that we run. So I think that's that. Why don't we look ahead to this week, Barry? Well, actually, before we look ahead to the week, Ryan, he always has these great stats that he comes up with. Many of you see them on Twitter. So the stat I saw late last week that I think is a really good one is, what happens when the S&P 500 goes up about 6% in Q1, right? What happens over the rest of the year? And when it's in that range, mid to high single digit returns for the S&P 500 in Q1, on average, the S&P 500 is up 12% the rest of the year, right? So that's like almost a 20% year if you add the Q1 returns. Would you take that, Barry?
I would take it, and that's
Me too.
That's historical data, right? We know that doesn't necessarily forecast what's going to happen in the future, but it lets us know what the patterns are, and those are important to watch. That is our market signals, is to be aware what happened historically. Yeah,
just you get these bumps, like you typically get a 10% correction early in a cycle like this, year 2 of a bull market, but you always end higher, at least based on the post-World War II bull markets, to varying degrees, but they've all been higher at this point. So we'll see if that history repeats itself. Looking ahead to the week, we get the some PMI data, which it's a lot of secondary data this week, Barry. What's actually the PPI, the purchase, the producer price index, wholesale inflation, that one's going to get some attention on Friday. What's on your radar for this week that investors should be watching?
Yeah, everyone's following inflation. One of the reasons that everyone's looking at inflation is that everyone's also following the Fed. The Fed has said that they think that any rise in inflation will be temporary, and markets are starting to test the Fed a little bit on their conviction behind that view. And we get the Fed minutes from a meeting from 2 weeks ago on Wednesday. Now, the meeting already happened. Press conference already happened, so a lot of the information is already out there. The minutes just give us a little bit of a glimpse at what's going on behind the scenes, and maybe not so much this one, but increasingly over the next few Fed meetings, those are going to be watched very closely.
Yeah, I think, what we hear from the Fed in the next month might not be interesting, maybe even the next 2 months, but it's going to get really interesting, midsummer to the fall. It's going to be very tough for them to stick to their outlook here, for rates in particular, but maybe even their bond purchases, we would think, could be pulled back by year end. We'll have to see. So I agree. The Fed, inflation rates and the Fed, probably the single most important thing for investors to watch over the coming weeks. But we're also going to get earnings season starting next week. So we'll talk more about that on the podcast next week. But that's something to keep on your radar too. So with that, I think we'll wrap for the week. Thank you, everybody, for listening. Thank you, Barry, for pinch hitting for Ryan. Ryan, have a blast at Disney. We'll be back kind of normal lineup here with Ryan leading the charge next week. So hopefully you found that enjoyable and helpful. We will be back with you next week. Thank you, as always, for listening to LPL Market Signals. Have a great week, everybody.